We're going to work on Clayton Company. We're going to work on break-even, target profit, and then contribution margin income statement. So let's start with A. So what is the formula for break-even in units? Fixed cost divided by contribution margin per unit. Alright, let's do the computation. They tell us the fixed cost are 13,000 plus 42 plus 70,000. So we had to add them up, but there's our total fixed cost and our contribution margin per unit. They don't give us that, but we can figure it out because we have the sales price and the variable cost. So we can calculate our contribution margin in dollars and divide it by 15,000, or we can divide each line individually by 15,000. I think I'll go ahead and do that. Let me get the revenue and the variable costs for each unit here. And then for the variable selling, it doesn't give me the dollar amount, but it tells me that it's 3%. So 3% of 30,000 would be 90 cents. Okay, so the contribution margin then for all of that would be the sales price minus each of these four variable costs. There you go. So we have a contribution margin per unit of $9.60. You could have also taken the 450, subtract 165, 105, 22.5, and 3% of the 450 and divide by the 15,000. Arithmetically, you get the same thing, and that would be a fine approach too. Alright, so let's put our contribution margin per unit in here, and I've already got the formula, so I get the number of units, 13,021 for A. Now for B, we want to know how many to sell to make a target profit. Alright, so we need to add target profit in with fixed cost in the numerator. So here I have a new numerator. It's the 125 plus the 20,000 target profit. Contribution margin per unit is the same thing. So now 15,104 units will give me enough to meet fixed costs and generate a profit of 20,000. And that's a before tax profit. In C, we want to know how to make that 20,000 after taxes. So after you take 20% of it out and send it to the taxing authorities, you want to have 20,000 left. So you've got to start with more than 20 to have 20,000 left after you write a big check to taxing authorities. So we have to solve for the before tax equivalent of an after tax of 20,000. So here's the formula for that. It's the after tax target divided by 1 minus the tax rate. Here the tax rate is 20%. So our target is 20,000 divided by 1 minus 0.2, so that would be 0.8. And we see that that 25,000 before tax will give us 20,000 after tax. So after you take 20% of that out, you'll be left with 20,000. And you can prove that if you want to just do the math there. So now we're going to do B again, except for this time we're going to replace it with the 25,000. So we took the 125 total fixed cost and we added the 25,000, the before tax target that will give us 20,000 after tax, divided by the contribution margin per unit, and so 15,625 units rounded will give you your target, your required after tax target. Now in D, they're not asking about units. They're asking about sales revenue. So how much sales revenue would you have to generate in order to earn 10,000 before tax? So rather than using the contribution margin per unit in the denominator, we will use the contribution margin ratio, which gives us revenue as the result. So let's do that now. So we have a numerator of 135,000. That's the 125,000 fixed cost plus the 10,000 target. And the denominator should be contribution margin ratio. So let's compute that. That's contribution margin divided by sales. 32% or 0.32, and let's calculate that out. And this is in sales revenue, not units. We would have to sell $421,875 before we would have the 10,000 after tax profits. So now let's work on E. we need a contribution margin income statement for 20% more units, 20% more than 15,000. So 20% of 15,000. So we would want an income statement for 18,000 units. All right, let's create one. So here is a contribution margin income statement. Sales minus the 4 variable costs gives us contribution margin minus fixed gives us profit. All right, so if we had 18,000 units, what would we expect? So sales price times the 18,000. Materials times the 18,000. Direct labor times 18,000. Variable overhead times 18,000. Variable selling times 18,000. Okay, and that gives us our total variable cost. So sales minus total variable cost gives us our contribution margin. There's our total fixed cost, which is the 13, the 42, and the 70. And so our operating profits are 47,800. Now, could you have predicted that this would be a positive profit, and could you have predicted that this would have been more than our targets of 20,000 and 10,000? Well, we were computing for 18,000 units, and if you go back to our prior, we only needed 15 to make those various targets, right? So at 18 we should have cleared those handsomely, and we did.